Hi, it's Nick Burke here from propertyinvestmentprofessionals.com.au. This is the third video in our 5-part video series called Where to Buy Investment Property. In the first two videos, we looked at the importance of infrastructure spending, job creation, and population growth on achieving our objectives of high capital growth for $100 a week or less and doing so safely with minimal risk. And it's this safety that brings us to the subject of this video. Safety is achieved through diversity. It's critically important as a property investor that we don't take on unnecessary risk. You could find a property investment with all the factors that we've looked into in the first two videos in this series, plenty of infrastructure spending, rising population and jobs being created. But if all this spending, all these jobs, and all this rising population is all in one industry, then naturally your risk levels are increasing. Sometimes you can get all these factors present, and it's not just siloed in one industry, it's even higher risk if the developments are related to just one company. So in the same way that your stockbroker may advise you to diversify risks by buying shares across a number of companies in a number of industries, you should keep the same principles in mind when investing in property. The more companies and the more industries, the better. Large capital cities tend to be the safest because places like Sydney, Melbourne, Brisbane, and some of our other capital cities all have dozens of industries and hundreds of companies to make them diverse. At the other end of the scale, some smaller towns are reliant on just one industry. For instance, some coastal towns are over-reliant on tourism, and some small inland towns are over-reliant on just agriculture, even one crop in some cases. In between, we have the large regional centres, and some of these are more diverse than others. So the best thing you can do is to keep your risk to a minimum by investing in areas where there's a number of industries. The more the better, and even better if these industries are investing in infrastructure, creating jobs and causing the local population to grow, attracted by the jobs. These factors create demand, and in the next video we'll be looking at the supply factors, and you can watch that video at propertyinvestmentprofessionals.com.au or by clicking the link on this page. Hi, it's Nick Burke here from propertyinvestmentprofessionals.com.au. This is the second in our 5-part video series called Where to Buy Investment Property. So far, we've looked at the impact of infrastructure spending. And in this video, we're going to look at the next two critical factors you should look for in ascertaining where to buy investment property. And they are population growth and job creation. Population growth is the catalyst for all increases in property values and rents. Without a growing population, you won't have growing prices. In fact, without a growing population, prices will stay still at best, or even decline. Consider, for instance, a country town whose sun may have set in previous decades. It used to house, say, 10,000 people, and now, because there are no jobs and few prospects, it's declined to maybe 6,000. Those remaining 6,000 will tend to be older people, and they won't be generating much in the way of new wealth. Few of them will rent, and there will be empty houses everywhere, in fact, enough to house 4,000 people. So obviously what we want is the opposite of this. Australia's population grows every year. The amount fluctuates, but in rough terms it's around 200,000 to 400,000 new people, which is about 1.5% a year. In addition, people move around within the country chasing jobs. So the trick is to invest in an area ahead of or during a sustained period of population growth. A good starting point is a population growth rate above the national average. So 2% is good, 3% is even better. But the demographics of that population are equally important. For example, an area that's surging with retirees will create price growth, but the rents won't be so strong because retirees don't have big bucks to spend on rent. Many of them own, which is what will create the rising values, but few of them rent. And if they do rent, they're often on fixed incomes and can't afford the sort of rents we're after as investors. So what you want to look for is areas where the population is growing, and that population is a young, working age population who are being attracted by the high-paying jobs. These people bring their partners and their families. They need housing, they're earning good money, and they'll spend a decent proportion of it on rent. They also often want to rent new homes, which investors can often provide because of the depreciation benefits. These working age people push up the rents, which means that investors don't have to contribute much out of their own pockets to provide the investment property. As rental yields rise, more investors are attracted to buy, which in turn raises values. And of course, some of the new workers will settle and buy, and this too puts pressure underneath property prices. So population growth and job creation, the right kind of job creation in particular, are two of the most important factors to look for when ascertaining where to buy investment property. And in video 3 in this series, we're going to be looking at the safety of property investment. And you can see this video at propertyinvestmentprofessionals.com.au or by clicking on the link on this page. Hi, it's Nick Burke here from propertyinvestmentprofessionals.com.au. This is the first in our 5-part video series called Where to Buy Investment Property. There are 3 major criteria that you should always bear in mind when looking for investment property. Firstly, you want to achieve the highest possible capital growth. Secondly, you want to achieve the highest cash flow so that owning an investment property won't cost you an arm and a leg. A rough benchmark that most of our clients want to achieve is a property that will cost them no more than around $100 a week out of their own pocket. And the third but equally important criteria is to invest safely, minimizing the risks as much as possible. So to balance these 3 factors, the first thing that we look for is infrastructure spending. Infrastructure spending is one of the most powerful influences of property price growth. So you should be looking to buy an investment property that's close to where new infrastructure is going. All sorts of infrastructure is good, such as new roads, bridges, train lines, but the best possible infrastructure for you to invest near is large-scale infrastructure that's going to attract people and generate wealth. New public facilities like schools, hospitals, shopping facilities. But even better is really large-scale private investment that can completely transform an area. These can be related to the resources industry, such as new ports, freight facilities, railways, mines, processing plants, and so on. And the reason these infrastructure projects make such a big impact on property values and rents is because they create surges in population and jobs. Large numbers of jobs, preferably highly paid ones, so that all those new workers need to seek accommodation. And they all need to either rent or buy. And when they come through in such numbers, they push rental yields up and create price growth as they buy. Both of which, of course, are excellent for investors who've got in ahead of this trend. And it's these 2 factors, population growth and job creation, that are the subject of our second video in this series on where to buy investment property. And you can watch that video at propertyinvestmentprofessionals.com.au or by clicking on the link on this page.